of Behavioural Finance Australia, and today I'm joined by Stewart Oldfield, who is the principal of Field Research, which is an industry intelligence organisation, and Stewart is also a freelance journalist from the Financial Review. Stewart, welcome.
Good to be here, Simon.
Great. Now we've got a fairly short webinar. It's only half an hour, so we're going to jump as soon as we can straight into it, but just a couple of words to set the scene. Stuart's going to ask me a bunch of questions about the new book that I've written, which you hopefully can see on the screen there, Applying Behavioural Finance in Australia.
Hard-hitting questions, Simon.
I'm sure I'm quaking in my boots as we speak. Now, Stuart's got a bunch of questions, but what we're also going to do is allow a little bit of time towards the end for any questions that anyone online has as well. So you'll see hopefully on your screen, if this webinar is working properly, a little chat box. So feel free to type in any questions that occur to you as we're going through. And if we don't turn to them immediately, we certainly will do towards the end of the webinar. In addition as well, I've prepared a few slides that may or may not preempt anything that Stuart might ask me, but at least will give you something to look at as we go on talking in the background. And let me just start flicking through those. Hopefully you can see these slides moving on your screen now, if everything is working. They are your presenters, so I'll flick past that relatively quickly. And I'll leave you with this just while we kick off, which is, for those unfamiliar with it, this is a Wordle. What I've done here is I've copied and pasted the sort of 65, 70,000 words from the book into this machine that has then created this pattern which demonstrates the words sort of in proportion to the prevalence of those words in the book. So you can see it's a book with focuses on investors, investment, decision-making, behavioural biases, decision-making, etc. I'll leave that there for a second, and I'll hand over to Stuart.
All right, Simon, and first up, congratulations on writing a fantastic book, 70,000 words, as you say, on behavioural finance issues as they can be applied to Australia. But first up, please tell me why you wrote the book and perhaps what gap you're specifically trying to fulfil.
Very good question. I do sometimes wonder myself, actually. 70,000 words wasn't the easiest task, I must admit. But I didn't actually set out to write a book at the outset. What I did was, at the end of 2015, I sat down and I thought, well, let's make a bit of a plan for 2016. And as I did, I set up a bunch of frameworks. And these were frameworks for consulting that I could do in 2016 and seminars and workshops that I can run. And each of those frameworks sort of set out a bit of psychology from the behavioural finance literature, some implications, some practical sort of outcomes for financial decision-making, investment decision-making, and then some solutions and sort of things that people can apply. So I sort of ended up with 12 or 13 of these frameworks, a whole bunch of bullet points on a page, and I thought, well, actually I can write those bullet points into proper sentences and paragraphs and turn each of them into a chapter. And that's sort of effectively what's happened here. Each of those frameworks is now a chapter in the book, and they follow largely the same sorts of frameworks that's derived from that bit of work I did late last year. But you asked as well what the gap was that I'm trying to achieve or to fill with this book, and what I have in mind, I guess, is a few things. One is that this book is specifically designed for the Australian audience. That's not to say that this stuff is uniquely Australian, but I do sort of contemplate things that are uniquely Australian, like self-managed super funds, for example, and sort of some of the industry structures and participants that we have here in Australia. Another couple of things that are important, I guess, or gaps that I was trying to fill were, well, one is to make it really a book about applying some of these behavioural finance insights, because there are books out there already that talk a lot about the literature, and from an academic perspective, there is a wealth of literature out there, but this is really a book that sort of takes some of that, certainly refers to it. There's 300 plus footnotes and 100 plus references in there. So it's a very empirically based, evidence-based book, but I'm trying to go beyond that into application. Also, it's independent. I'm not pushing a particular financial product or solution here. In fact, for readers, you'll see there's a whole lot of different fund managers and different approaches from consultants and others mentioned in here, where what they're doing aligns with behavioural finance principles. And finally, it's really aimed at the sort of more sophisticated end. So this isn't a mainstream book for mum and dad investors. It's aimed at a professional audience, a financial advisor, a fund manager, excuse me, a super fund trustee, and maybe some sophisticated individual investors in the mix as well.
Gotcha. All right, so that's a broad audience, and one of the first things you say in the pages of the book is that behavioural biases are pervasive in the Australian market. So does this mean that this is an academic book, or is this a book that will help make me a better investor and help make me make money?
Well, it's an interesting question. I mean, when I say they're pervasive, they are documented to be pervasive when you look at sort of large-scale behavioural finance research. But what I do throughout the book is reflect on my experience with working with financial decision makers specifically, so teams of, for example, analysts in fund managers. You look at sort of some of the practical outcomes in the Australian context. So when you line up what the evidence shows and then the practical aspects of sort of the reality of making decisions in an Australian investment context, then yes, I think it is fair to say it's pervasive, but the evidence is the book. I'll let people be the judge.
All right, and I've got a slide there. I thought it might be a good way to set the scene that sort of breaks where behavioural finance issues can be broken up. So do you want to refer to that?
Should we talk to that? Yeah. So broadly, where the book looks at the application of behavioural finance is in three groups, which you can see. Hopefully, you can see that slide in front of you there, which is saying, well, behavioural biases. If you start in the bottom right-hand corner there, behavioural biases apply to clients. And of course, here I'm referring to the context of a financial service professional, a financial advisor, or a super fund, or fund manager having clients. They have clients. There's biases that apply, and that's, I think, becoming more mainstream. People are more aware of some of those issues, some of the sort of simple decision-making traps that might apply in the context of a relatively disengaged member of a mainstream super fund, for example. So I cover that to a relatively small extent, but there's sort of maybe 10 or 12 sort of engagement strategies and solutions around client decision making. Then at the top there, I've got markets. So this is saying, well, if individuals are making a bunch of investment decisions that may be distorted in one way or the other, these individuals might be individual investors or the investment decision makers in major funds or other professional investors. If we are all systematically making these sorts of decisions, how does it all aggregate up into markets? What are the distortions that might apply to market level, whether they be booms and busts, or where they might be sort of the characteristics of stocks that tend to get overlooked or overbought or oversold, or specific situations in which certain types of the way information is disclosed, excuse me, or the characteristics of CEOs might offer opportunities. And then in the bottom left-hand corner there, we've got ourselves. And what I mean by ourselves there is more of the sort of sophisticated professional investment decision-making, or in the case of sophisticated individual or high net worth clients, individuals as well. And that's, I think, to me, is the biggest blind spot currently in our industry. That the markets and the clients, we're sort of comfortable thinking about those because they don't really apply to us. But the decision-making biases that apply to ourselves are the ones that we tend to overlook. We tend to think that we are different from others, and I spend a fair amount of time looking at, well, what are some of those effects that apply? Not necessarily the same sort of simple things that apply to clients or sort of the less sophisticated clients at the end of that sort of spectrum, but certainly there are some sort of more sophisticated decision-making biases and distortions that we as an industry need to come to grips with and overcome.
But Simon, I'm a sophisticated investor. You're not suggesting that I might have some be subject to behavioural biases myself, are you?
I'm sure, Stuart, you are different. or that is the case. No, actually, I should say, if you are a human being, the chances are we should expect human beings to be prone to various decision-making biases. But having said that, not all biases apply to each person individually. Certainly different things apply to the sophisticated end than do apply to less sophisticated, for example, disengaged members of major super funds. So that there is a spectrum, but the main problem, I guess, is to overlook our own biases in this process. So, yeah, particularly if you feel you're a sophisticated investor, a fund manager, as someone who's sort of been in the industry a long time, then the sense is likely to be that, well, actually this stuff applies to somebody else.
You talk about disengaged members of super funds. One at the market level, as you've broken into three segments. At the market level, the Australian market has a high proportion of self-managed super funds. Does that have any implications for the sort of biases that might get reflected in our market?
Yeah, well, it's interesting because when you look at what applies at a market level, some things apply differently depending on which types of investors might participate in which parts of the market. So if there's lots of individual investors who are managing their own self-managed super funds, for example, just from the nature of them investing smaller amounts of money, they can practically invest in smaller stocks with less liquidity, for example. So you do see that there are some of the distortions apply more so for stocks which have lower market caps or smaller, a lower liquidity, lower turnover, and tend to have a higher sort of retail base compared with some of the sort of more institutional investment sort of market, large cap type stocks. So yeah, it does make a difference.
Did I just hear a money-making opportunity that small cap stocks, because we have a high level of retail investors, are perhaps more prone to some of these issues that you've written about?
Well, yes and no. So yes, they are more prone, and there's plenty of evidence that shows that certain of these effects are more applicable. Actually applied if you're a major investor, isn't it? It's harder to go and say, you know what, I'm going to take advantage of this and I'm going to go and plow a few $1 billion into small caps. Well, you go and do that, you're going to move the market. So yeah, I'd say there is an opportunity, but perhaps more so for small investors to take advantage of than sort of the broader sort of investor base, perhaps.
And like many people on this webinar, I have to deal with clients every day. How will this empower me to better advise them?
Well, part of it is to understand, I guess, some of the major biases that apply to clients. Part of it is to understand the way that you can influence them better. And when you say clients, I guess we're talking about different types of clients here. So an advisor speaking about their client is going to be quite different in many ways to, for example, an asset consultant talking about their major super fund client. But in both cases, there are going to be behavioural insights that apply, perhaps in different ways. But there's a lot of interaction that happens. In fact, I've got a slide on this coming up, which I'll just put up here as well. Which just sort of highlights, I guess, that there's a lot of biases that apply and are discussed in the context of individual decision makers across the sort of the investment landscape. But there's a lot that applies between them. So decisions that corporates make, for example, will impact the way fund managers react to them. The decisions that fund managers make will have implications for the way that the research houses and asset consultants who assess them might have, which has knock-on effects for super funds. And then the whole thing actually applies in reverse. So super fund decisions, the way they assess fund managers, has implications for how fund managers behave, the way they construct portfolios, and the way that fund managers assess stocks then has implications for how corporate decision makers then go about making investment decisions on behalf of ultimate shareholders. So yeah, up and down and across the industry, there's a wealth of interactions, I think, between some of these effects.
So you're saying that an asset consultant can use this book to better assess fund managers that they allocate money to?
Yeah, so asset consultants and anyone else who's assessing fund manager performance and making choices about which fund managers they think might or might not add value. There's a whole chapter dedicated to that topic in itself. And then there are broader aspects of it sort of scattered throughout the book when you look at some of the other major market effects and whether a fund manager may or may not be capturing them. There's a chapter on forecasting, for example. How does the fund manager do their forecasting? Does their forecasting add value compared with a sort of, I guess, a simple algorithm that might say, hey, let's assume it was the same as last year, for example. So there's a bunch of things that an asset consultant or anyone really who's assessing a fund manager and doing a fairly in-depth analysis of a fund manager can capture from this book to make a better choice. And hopefully by making that better choice, actually there's a knock-on effect for the choices the fund manager makes and ultimately a knock-on effect to the returns that clients get.
Many people on this webinar, though, will be financial planners advising mum and dads. what specific conclusions have you reached in writing this book that would help those financial planners deal with those less sophisticated clients?
Yeah, well, there's, I forget the number, but perhaps in the order of 10 or 12 specific strategies scattered throughout the book, amongst other things, that are really designed for that interaction between a sophisticated advisor or a super fund that may be dealing with a less sophisticated end investor. And it depends on characteristics are of that client, for example, and what some of the decision-making biases are. So, for example, I talk a lot about overconfidence and how it applies in the context of a sophisticated professional investment decision-making framework. But actually, I guess an advisor who may have someone coming in who thinks that they can pick stocks better than the advisor or better than the professional managers out there, well, what can you do to help perhaps bring to light some of the evidence to that individual to say, well, okay, maybe go ahead and do it, but let's try and mitigate the risk. So in that case, there's sort of bucket strategies, for example, where you might say, all right, well, let's have 90% of your portfolio allocated in a way that is consistent with your long-term goals and is managed on a sort of a rigorous basis that thinks about after-tax consequences, that thinks about trading costs, that thinks about all the sort of issues that we've talked about in some of the chapters in the book. But really, if you still feel that you can do it, let's allocate 10%, say, for you to keep going and making those choices. It allows the person to continue to be overconfident, to continue to have perhaps the enjoyment of managing the stocks in their own right, but it mitigates the risk that it then destroys their financial future. So that's a sort of, I guess, an example, and there's a bunch of those depending on the characteristics of the client.
And you've interviewed some wonderful people from this book, and you've quoted some globally significant investors talking about how they manage their own money in perhaps less than an ideal manner. So you mentioned topics such as overconfidence. Are you surprised that about the level of sophistication or otherwise when you talk to these professional investors that they've got some work to do in terms of understanding behavioural finance type topics?
Yeah, well, I'd say that the people I've quoted in the book are all doing things that are consistent or aligned with some of the principles and the research that I'm discussing. So they're probably the standard examples of what you can do right. But I guess where the surprise comes, I guess, is the level of disconnect more broadly through the industry. And when I say disconnect, I mean the disconnect between some of the underlying behavioural finance research, some of which has now been well established. The psychology, some of it now dates back to sort of the mid-late part of last century. So some of what we've known for some time and has been well documented, large-scale sort of statistically significant surveys that have clear consequences and takeaway messages for the industry. I've quoted a bunch of people who are applying that sort of stuff in various ways in their investment processes, but I guess the surprise is that there's a fair swathe of the rest of the industry that isn't.
And so when you read that Australian investors are massively overweight domestic stocks, for instance, is that an example of perhaps a bias?
Yeah, well, that's an interesting one, because there's always the argument of, well, franking credits justify an overweight in Australian equities, and you think, well, fair enough, there probably is a bit of an argument that the weighting be higher than the 2% or so that we have in the total weight of the global MSCI World Index. But when you look at the academic research, and they employ various modelling techniques to try and unpick, well, how much would this justify? How much do perhaps lower transaction costs and better tax consequences apply in Australia? Well, it doesn't seem to be enough to nearly justify the overweight that we have to Australian equities. And similarly, when you go and look at other countries and go, well, is this a peculiar Australian effect because of our particular tax consequences or our transaction costs or how mandates are constructed or liabilities are managed or whatever it is? Well, no, it's not, because you see the same effect very similarly, very large proportions of equities portfolios in other countries. Finland, for example, Finland might be, well, a fraction of a % of the global market, but still Finnish investors have a very large overweight to the Finnish stock market. So that's I mean, it's simple to say, but then you go, well, why is it occurring? And when you start to look at the very sophisticated end of the market, you go, well, no, this is an outcome and asset allocation modelling tool. But the modelling tool itself is then subject to the biases of the people who construct the modelling tool. How do you define asset classes, for example? Do you define them as Australian equities versus every other country, for example? Are geographic boundaries the right tool, the right sort of measure to be constructing this? Why is Australia special, the tax consequences aside? Why do we have this other aggregated all other countries bucket, for example? So when you think about how the question has been framed that goes into some of those modelling tools, you think, well, actually it is subject to some of the same sorts of biases. We shouldn't be distracted by the fact that it's a sophisticated modelling tool. We shouldn't be distracted from the fact that actually it's still subject to some of the same sorts of issues that financial decisions made outside the context of models are made as well.
And you, I see that you have written each chapter to be largely standalone. Does that mean I can sort of pick and choose the chapter that's most relevant to me? And is that how you advise approaching the book?
Well, I've written that actually as a possibility. I mean, if someone is particularly interested in the value effect, you can go and turn to the chapter on the value effect, and it is sort of standalone. Having said that, though, some of the concepts do build on each other. So if you get to the section, you go, I'm interested in forecasting, and there's a chapter on forecasting sort of 2/3 the way through the book. Well, some of the concepts that are discussed in forecasting have repercussions and sort of implications across some of the stuff that's been covered to date, covered up to that point in the book. So yes, to extent, but it does sort of compound and build on itself throughout the book.
All right, and perhaps tell us a little bit about yourself and how you arrived at having your own advisory business yourself. So why are you passionate about this topic?
Well, I've come from a psychology background originally, so I did a degree in psychology and started out doing as a research assistant in psychology and did work for a market research company. So I sort of started off with the sort of behavioural insights underpinning, but then everything else in my career and studies has been finance investment decision making, either as an asset consultant, some major super funds, working with financial advisors and accountants, particularly around self-managed super fund investors and advice, and in investment banks, so working with CEOs and CFOs doing equity capital raisings, debt capital raisings, mergers and acquisitions, and major corporate financial decision making. So having seen a wide scale, broad sort of arching range of financial decision making and having a background in psychology, and then actually I went back to do a subject at Macquarie Uni where I did my Masters of Finance a few years back, and the way it was presented was, well, look, there's a whole lot of really interesting, powerful evidence here from behavioural finance, but the presenter's like, well, I'm not a psychologist, so I really can't talk to you about that, but you really should read this sort of stuff. And I figured, well, maybe there's a bit of a gap here between what the academics are talking about and sort of the finance academics and the psychology academics and then the practical applications. So having sort of been out in the real world and working with a whole lot of different financial decision makers, I thought, well, what can I do to try and help close some of those gaps, be they gaps in individual investment decisions, working with advisors, be that sort of the big end of town, or be they in this context of corporate financial decision making. So this, I guess, the book is one attempt at sort of helping to try and close what actually the evidence shows is a multi-billion-dollar gap, and it's not small.
Did I just hear multi-billion-dollar gap mentioned? Did I?
Well, when I say that, I mean it sort of rolls off the tongue. But one of the largest studies when looking at it at a national level was done in Taiwan. From memory, it was about 2.3% of Taiwan's GDP was the financial consequences of several behavioural biases that the researchers there looked at. Now, 2.3%. It's not going to obviously translate directly to the Australian context, but if you look at 2.3% of our GDP, I mean, that is a very large number. That's like wiping out the whole utility sector of the Australian economy every year. So if my little contribution to all that is a fraction of a fraction of a fraction, it could still be a very large number.
You've got my attention. So and what does your firm Behavioural Finance Australia do?
Well, we run seminars, for example. We run workshops in-house and publicly. I've got a couple coming up, actually. So for people interested in things like client engagement, the next couple of sessions coming up in Sydney and Melbourne are specifically focused on client engagement strategies. So some of the stuff that's in the book, but is not the main theme of the book, but certainly is in the book. Some of that stuff is incorporated into specific workshops that we're running in over the course of the next month, 6 weeks or so. But then there's other stuff coming up on investments, and it's interesting actually, because the people who are interested in this topic come with it with a range of, I guess, different things they're trying to get out of it, different preconceptions about what it might offer them. So I guess what I try and do is be sensitive to where the opportunities are and what people are interested in, and provide training and then assistance and consulting, I guess, into implementing some of this sort of stuff in people's businesses, and hoping to make some real consequences to business outcomes and to financial outcomes.
All right. Well, I mean, I should say congratulations on the book. It really does seem that you have interviewed some amazing people, and as you say, it's a evidence-based book, 300 footnotes and 100 references, and I think you should emphasise just the point that you are an independent expert, so you're not pushing any particular product. Your work relates heavily to equities investment in general, but beyond that, you're here to add something to this topic. So I want to know where I can buy your book.
Well, just as I'm answering that, I might just, I think we'll probably have to wrap up after this question. So while I answer that question, if you've got any questions yourself, please do type them in the chat box. We've got about, I think, 3 minutes or so left in this session, so we probably can do 1 or 2 questions if there's anything coming through. The chat box hopefully is working. I'll see if anything comes through. But in response to the question, so on my website there's a page that gives a bit of a blurb about the book, but also links to some of the online retailers that are currently selling it. It's been an interesting journey going through publishing and distributing the book, I must admit, and the journey hasn't quite finished. But at this stage, Amazon, for example, has paperback and ebook formats available. There's a couple of Australian online retailers also selling the book, I think possibly a little bit cheaper than Amazon as well, although prices seem to fluctuate beyond my control, unfortunately, which I'm finding out is the case when you sell a book. But anyway, there's links on the website. In addition, I guess when I run sessions, I tend to either make the book available to purchase directly when I'm there, or for participants who are paid to attend the sessions, often give them copies as well. So that's another alternative for people coming up to one of my sessions. I'll be doing a couple of client engagement sessions in middle of next month, so if anyone's interested in that, they'll probably receive a copy of the book as a participant in that session. And in addition, I'm presenting to the Behavioural Economics Network, which is a meetup group in Sydney, from memory, on the 17th of August, but details will be online. Very good group, 1,200 or so people participate in that network. I think they get roughly 100 people attend a range of behavioural economics related discussions each month. So mine's behavioural finance, but sort of behavioural economics is a related field. Okay, so we're almost there, 1 minute to go. No questions in the chat box. I'll give you 5 seconds if anyone's about ready to hit play on the, or hit to enter on their question. Otherwise, I think we're done. I hope you enjoyed the webinar. Thank you very much, Stuart, for asking your questions. They weren't too tricky. I think they managed. Well, look, okay.
Bottom line is, Simon, I think your book has made me a better investor, and I'll certainly be recommending my clients read a copy as well. So congratulations again.
Thank you. I'll put you down for 10 copies then.
Done.
Perfect. Thank you, everybody.